Okay, chapter 8 is on investments, and let's go ahead and get started. Now, the first thing we're going to do is the investment categories. And debt securities, these are like when you buy bonds in another company, for another company. And equities when you buy the stock. So bonds are basically when you're loaning money to another company. And equities when you're actually buying the stock. So, you know, it kind of comes about because having cash laying around is probably not a good idea. You want to have your assets actually making money. So a lot of times they'll either invest in stocks or bonds of another company. They give you federal bonds and that too, but they're basically there a lot of times just to keep your assets making money. Is basically what you try to do with it. Now, it matters how much control you have with the companies for equity investments anyway. So let's take a look here again. So debt securities, these just pay interest. There's not too much exciting going on, although there are a couple of categories here that they have that we used to have an equity stock, we don't have it anymore. Trading and available for sale. And the weird thing on these are the unrealized holding gains and losses. So this is if they go up in value or down in value, but you don't sell them. You know, especially look at a stock, let's say I buy IBM stock. What I pay for it and what it's worth at the end of the year might be two different things. It might have gone up in value or down in value. Those are the unrealized holding gains or holding losses, because while the I haven't sold it, I still have the stock, but the value of it might be different. It might be either higher or lower. So they call those unrealized gains and losses. And for a lot of stocks, like if it's an IBM stock, it's pretty close to cash. So that's why we recognize it as it's unrecognized as far as being actually sold. We will recognize it in the income because, again, you could sell the IBM stock in 10 minutes. So that's kind of what we're getting at here, that this unrealized holding gains and losses are the one. You know, if you sell it for more or less, it's easy to come up with, whether they're gains or losses, but it's these unrealized ones. Now, we have basically three categories for the equity stocks. The fair value method, which is one we're going to talk about. And all the unrealized holding gains go to the income statement. I don't know, there's probably a better way for me to show this, but the equity method we're not going to talk about, and consolidations we're not going to talk about. And these are different methods. These are when you own so much of the company that you're influential or controlling. So influential, you may have someone on the board of directors. Or controlling is if you own over 50%, you control the company. But we're going to look at this one. This is probably where most of them fall in. If I buy IBM stock, I'm probably not buying enough to be influential. And the general rule is 0 to 20%, although the real test is if it's non-influential or influential or controlling. So these are the real, the real criteria are these, influential or non-influential, controlling, but these were kind of put out. It's kind of a funny thing that 0 to 20%, 20% to 50%, over 50%. The 0 to 20% is just completely arbitrary. And it was given out as an example when they released this new rule of controlling versus non-controlling. And people just picked up on it. If it's less than 20% not controlling or not influential, when in reality, if it's say a public traded company, if you own 5% of it, you're probably influential. But so these are general rules. But the real thing is if you're non-influential or influential, that's how you categorize it. So the influence is how these get categorized. Let me write that down. So they're categorized by influence. So how much influence do we have? Okay, let's see how these go. Okay, so here we have some securities. These are trading securities. This is old terminology. The new terminology is our fair value securities, because these are equity securities. Oops. And because these are equity securities, we don't have these categories anymore. So it's really, these are really should be called fair value now, but either way. And I think a lot of people still call these trading securities because the available for sale securities, when they were stopped, and the trading ones too, we basically account for them the way we used to account for the trading securities. So there are people that I think, they probably have their systems set up that you categorize everything as a trading security because that's the new way for doing all of them. So maybe, you know, I could imagine that if you're in accounting, you say, okay, everything's a trading security now. But it really is called a fair value security. We do what they call a portfolio approach. Companies may have dozens of investments. So we take it as a portfolio. So here's our cost. Let's add that up. Hey, that's not centered. And here is our not centered also for some reason. Total. So here's what it cost us, is our total portfolio. And here's what it was worth at year end. Now we haven't sold these yet. These stocks are not sold. There's no cash changing hands here. So we're simply looking at the value of them at year end and seeing, you know, how much they went up or down. In this case, they went from 695 up to 745. So we have a gain of, oh no. Okay, so let's see here. So 745 is the year end, the cost is that. So if we subtract that, oops, don't do that. So this will be a $50,000 unrealized gain. So unrealized gain or loss is an amount of, oh, $50,000. Ah, let's try that again. I'm gonna do this a little differently. I'm gonna put the complete label on. And I'm gonna get a little closer here. How about? Okay, let's see what this. What is the effect of net income if Nichols securities were worth 280,000 at year end? Okay, so I'm gonna say copy this whole thing down here. Okay, so what's it saying? The Nichols securities were worth 280,000 a year. So 280. Okay, in this case, we would have an unrealized loss. Again, we didn't sell it, but was beyond unrealized holding loss. 20,000. So if this was changed, we changed it from 350 to 280, we have an unrealized holding loss. And again, these investments are not sold. We didn't sell them. If we sold them, there'd just be a regular loss or gain, like any other gain or loss. But these are unrealized. The way we got these terms, they came about is kind of interesting in that these were originally, these categories were meant only for banks. But by the time the rule came out, banks were exempt from it, but everybody else had to follow them. So it's kind of a weird thing that it was originally set up to have better disclosure for banks, but the banks are not, they're exempt from it. Okay, now this one is year to year. Oh, you know, I remember this problem. I don't like the way this one's set up. So here's the cost of these investments, and here's where the market value is at the year end for each of them. So this is the cost. So I'm going to put this in chronological order. And I think it's this way on your problems too. You know, this was the cost, and then these are the values each year. So we're going to figure out how much they had for a gain or loss for each of these years. So we'll say, so if they're plus, they'll be a gain. If they're minus, they'll be a loss. Okay. So we paid 19,800 for the portfolio. Let's zoom in a little bit. And it went up to 19,900. So in this one, we will have a gain of 100 in 2020. Now, this is what we're going to start at for the value of it in 2020. So when we go to the next year, we're going to say, okay, let's see, we end up the year at 18,300. We had this on the books at 19,900, so we had a $1,600 loss. So it's between these two now for this one. My famous arrows are coming out. And we're going to do this for each one of these. Okay, so 19,900 to this would be a loss of that. We're up to 19,200 minus. So our gains will be from one year to the next based on the ending values in them. So gain or loss, so we'd have $100 gain, $1,600 loss. Oops, too much. And a $900. I'm sorry. Some crazy person is typing on my keyboard. Okay, so this would be unrealized. Okay, so. Can't be like that. Okay. That's it. Nice short chapter. Okay. I will see you guys for chapter 9.